Welcome to In Early, the crypto podcast, where I speak to those at the forefront of the digital asset space, telling real-life stories, discussing the growth and growing pains of the industry, and exploring how blockchain technology has made an impact on people's lives. My name is Matt Green, and I'm the blockchain litigation lead at Shoesmiths. This week's episode features Peter Shekleton, a director of sales at BitGo, a regulator provider of custody, financial services, and core infrastructure for investors and builders alike. We talk about what holders of crypto assets should consider, why BitGo have been making positive headlines for safekeeping funds previously held by FTX, as well as the role of custodians, how they seek to protect assets and put those funds to work. Shek, welcome.
Hey, Matt, great to be here.
Thanks for coming along. Really appreciate it.
That's cool. Thank you.
So in the audio introduction, I introduced BitGo using language I shamelessly took from your website. For those not familiar with certain concepts, what does BitGo do? And it does three things, right? So maybe describe what those are.
Sure. So I think the best way to describe BitGo, I mean, we're one of the largest and oldest, if not the largest and oldest independent crypto custodian, where we're coming up to 10 years in the market this year. So obviously, as the name suggests, we're custodian of digital assets. We were not a custodian of real world assets before that. We've always done digital assets, so we're very much a crypto native business. And we've evolved, I guess, in lockstep with the market and the market structure. So, initially we started off as a technology solution, and I'll expand on that, I'm sure, later on in the podcast. But then, as we always had a sort of institutional B2B sort of focus, and as more institutional players came in, the market structure developed somewhat. We also became a qualified custodian, which means we're regulated. And again, I'm sure we'll touch upon that in far greater detail. And so we provide essentially at its core like a foundation to safely hold digital assets for a variety of customers, and then provide a platform from which they can safely deploy these assets into various strategies into the digital asset ecosystem. So, staking, DeFi, NFTs, trading, lending, borrowing, etc. And again, that's whole product mix is constantly evolving in line with the market. So I think that's generally what we.
That's the nutshell.
That's the nutshell. That's
basically it's storing for people, custodial in sort of very basic terms. So it's storing digital assets, and not just that, but it's putting it to work so you get some sort of yield from.
Well, I mean, only if the client, the first and foremost, the role of a custodian, and we really believe in segregation of duties in the market, is to safeguard clients' assets. So we first and foremost provide them a safe custodial environment to hold their assets. And if they only decide to just hold their assets with us, that's absolutely fine. But then we provide them the option and the opportunity to deploy those assets so that they're not dormant, and passive, but that's entirely driven by their investment strategies ultimately. So we're not, actively encouraging clients to deploy, but if they want to deploy,
it's an option.
It's an option, but it's an option. They can do it from us rather than having to move those assets on an exchange or on a DeFi platform that is, sort of not as secure as ours, essentially. So
why would anybody not want to put it to work? Is it because it's a time thing? Someone might want to maybe drop off their digital assets with you for, a couple of weeks. Would that prevent people from wanting to put their assets to work?
No, absolutely not. I mean, they could, they could obviously, depending on the protocol they stake with, they could stake it. I mean, some have longer periods than 20 days or 3 weeks. They could lend it out, intraday, which we do, or overnight. They could trade it in and out, within those days. So no, there's absolutely no restrictions. But I think to your question, why would people not want to do anything with it? It just, if you're a sovereign wealth fund, or if you're a long-term hodler of Bitcoin, and fundamentally, obviously, we evolved with the market, but at our core, we're very strong in the Bitcoin market, because obviously when we started, that was the core digital asset. People just want to hold their assets in the safest possible place and not touch them, and make sure they're preserved for themselves and future generations. So we have those type of clients, and we have clients obviously who are much more active in Polkadot, Solana, whatever, and who are deploying those assets.
So it's not just ways. Bitcoin, you can hold a variety of things.
Yeah, exactly. Let me give you an overview. I mean, I think, as I said, Bitcoin is still very important to us, and we still very much support the development of the Bitcoin network and the broader adoption of Bitcoin, because our founder and CEO, Mike Belshie, who's has a sort of long illustrious career in technology, across Web 1, Web 2, Web 3. He got into Bitcoin very early on, and him and his friends essentially had no safe place to store their digital assets. So he pioneered the multi-sig signature concept for digital assets.
What does that mean for people who don't necessarily know?
It's a way to safeguard your digital assets, which doesn't rely on only one key. It's a distributed way to sign transactions, and so there's multiple signers. And again, we can touch upon how we deal with multi-sig, but essentially, it's the key is still the predominant way for safe custodial solutions to sign transactions in digital assets, essentially. So he pioneered that, and obviously it started off with Bitcoin for himself and his friends and the institutions that became our clients. So to this day, 20% of all Bitcoin transactions still go in and out of a BitGo wallet, for instance.
Wow.
We're the sole custodian for the wrap BTC protocol. We obviously, promote and support sort of developments, for instance, the Lightning Network, micropayments in emerging markets, etc. Obviously we support the Lightning Network. We run our own nodes. It's something that we offer potentially to our clients, depending on the jurisdiction, etc. Obviously, we were involved with the government of El Salvador, providing wallet infrastructure for them with their adoption of Bitcoin. We're having conversations with, other sovereigns globally, and, just with the sort of Bitcoin wallet architecture, things that we do. So very much, a strong Bitcoin foundation, but absolutely not Bitcoin exclusive by any means. We support all the the top 20 tokens, I think 26 or 27 blockchains now, 700 tokens. We're doing a lot of things in NFTs and Web3. So we're really pushing the boundaries of what can be done, and we're very crypto agnostic.
Well, you sort of answered my next question to some extent a little bit ago, when I was going to ask what challenge you want to overcome, or what challenges does BitGo overcome, but it seems as though the answer was that the founder wanted somewhere to securely store assets, and that seems to be it, and it sort of evolved from that.
Yeah, I mean, so I think he initially, and obviously I don't want to speak for him, but because I wasn't around.
Chances of him coming on this?
You never know. I'm sure he listens avidly to all my podcasts.
Yeah. Absolutely.
No, he wanted to provide, he's a technologist, as I said, he found a solution. He founded a solution for safely storing digital assets. And it was initially a technology solution, but it evolved into much more than that. There was clearly a need for it, driven by the market structure in crypto, or the lack of market structure in crypto. And I think that's why you've seen these sort of elements of centralization, with exchanges, for instance. I know we'll touch upon this, becoming custodians and just becoming jack of all trades, which you would never dream of having that type of market structure in TradFi. And so he's tried to evolve in parallel with that and offer an alternative, more robust long-term.
But there's a reason why BitGo is advising and dealing with sovereign nations. I guess it's because of the length that it's been around, and the fact that it's stood the test of time in that respect, and it's evolved. So that's quite impressive, given that we've seen lots of failures in the market. I guess one of the examples of adapting to the market is this idea of wallet as a service. So can you tell me what that is, and why would people use it?
Sure. So I think it goes in line with, not just being a custodian, but being sort of a soup to nuts, full breadth offering. And you can absolutely expand on that and sort of add payments and add various type of, additional ancillary services that you may be able to offer. But increasingly, we want to become more of a one-stop shop, naturally, for any type of crypto business to be able to come to us and deploy whatever strategy they want to. So if you look at our client type of clients, there is no real archetypal type of clients. I mean, obviously, naturally, we're still very involved with the crypto native businesses because of when we started, how long we've been in the market. So I think today, 35% of crypto exchanges globally are clients of ours, for instance. So we have, huge sort of long tail of crypto exchanges and payment providers and remittances and crypto miners and so on. But we also obviously do a lot on the traditional infrastructure side and sovereigns, as we mentioned already. So there's really no typical client, and they all have different needs. So we just want to enable them to be able to deploy and use our wallet architecture safely and at scale. We're obviously exploring a lot more tokenization, real world tokenization at the moment. We're very active in, I guess, what I call the Web3 space, but in essence, more the sort of Web2 to Web3 transition.
Yeah, the transition.
So we're working with a lot of brands about sort of scaling a Web3 offering for them. And what's important for them is essentially dealing with a mass retail market that really doesn't understand crypto and doesn't want to and doesn't have the capacity or the scope to be using wallets and dealing with seed phrases and private keys. So, we abstract away the blockchain for them and offer them a solution to do that, where they have a very Web2 interface, but actually
they don't need to deal with all the technical stuff.
They don't need to deal with the technical, so we can do that. So this is what I personally think is sort of wallet as a service. It's just using this wallet infrastructure and architecture that we have across multiple different strategies that our clients can just plug into. And the important thing, on the more technical side, we, to your point, we're 10 years in the market, so people trust us, people know us, and a crypto year is like a dog year, so that's a long time in the market, right? And we have a open source battle tested code, which has been, is regularly audited, and as I said, there's bounties out there, it's audited for, so people really trust our tech stack, and we have a very simple single API that people can integrate with that gives them access to all of our different wallet services. So
it's simple to interact.
Very, very appealing. It's very simple to integrate a service that we don't currently provide, say, payments and in certain areas, etc.
Just moving on a little bit then, one feature of the website, and again, I admit that I have just been scrolling it to try and find some topics to really nail down on. One of the topics on the website is safeguarding digital assets. And the website says, and I quote, "Get insured, regulated, qualified custody." What does that mean?
Well, it's a very good question, because that's really our USP and our bread and butter, right? So a custodian, I think, is a very loosely banded term in the crypto world.
Very.
But actually, a lot of solutions out there are just technology solutions that offer you some form of secure signing mechanism for a hot wallet, which are sort of internet connected, wallets. And sure, like they offer sort of the flexibility and of being able to transact at scale, but they do not offer you what a real custodian is, which is safekeeping your assets in a regulated, insured, fiduciary manner, and essentially bankruptcy remote, and we've seen the importance of that with all the failings last year culminating in FTX. So with that in mind, and, in line with us evolving with the market, we became a qualified custodian in the US in 2018, and by qualified custodian is the term the US uses to.
That was my question. Yeah, what does that mean?
Regulated custodian.
Right.
So it's a qualified trust.
Yeah.
So it's a trust status, which obviously you know a lot more than I do about. But my understanding is obviously in a trust, there's absolutely no commingling of funds between clients, the exchange, and our own funds. And there's obviously that element of bankruptcy remoteness. So in the event that BitGo or the exchange were to go down, those client funds sitting in the trust, would not be commingled with the other funds of the exchange. So in a bankruptcy proceeding, there would be absolutely no issue whatsoever with retrieving those funds. They would be almost paid back.
So it's completely separate.
Completely separate.
Right.
And essentially, so we have trust entities now in 4 geographic locations. So we're regulated in South Dakota, in the United States, in New York, and we're equally regulated in Germany, in Europe, actually regulated by BaFin, and regulated in Switzerland by FINMA. And then we've been able to sort of port that license to various European jurisdictions, and we're in the process of getting further sort of trust statuses around the world, in Asia, Middle East. And we can talk about technically what enables us to achieve that trust status, but essentially what it also means is because we have that trust status, we can get those wallets in which the funds reside, which we call cold wallets, insured. So we have an insurance policy underwritten by Lloyd's of London Syndicate, which covers $250 million worth of.
And is it over the assets or over the storage?
It's over the trust itself.
Over the trust, okay.
And it's on a per wallet basis.
Okay.
So it's not $250 million per wallet, but the way, there is never more than $250 million held in any given wallet.
Right.
And the reason reason why we have this trust status is we, under the multi-sig framework, we control all the keys of the signing process for the client. So we generate those keys. They're generated offline. They never touch the internet. They use obviously our technology and our software stack, and they're held in that trust entity specifically. So all these elements mean that we can benefit from that insurance policy. So all of that gives our end clients huge, peace of mind to know that their assets genuinely are safe. And it's very modular. We have different wallet types. So that's the regulated, insured, secure wallet.
That's the super premium version.
Premium, but obviously it comes with limitations in terms of how do you access your funds? How do you withdraw your funds? And these are deliberate limitations because it's not meant to be a transactional wallet. This is, your hot wallet is like a debit card, and your
more accessible. The assets are plugged into the internet,
like a bank vault essentially.
Yeah.
And so we offer a combination of the two generally. And so clients like an exchange, for instance, will either because by their own sort of policies internally or because on some instances the regulator dictates it, will have a predetermined split of assets between hot and cold. So they will have 90% of the assets in cold, and they'll have 10% of their assets in the hot wallets, which enable, which
they can play around with.
The customer deposits come in and out of, and it gives them enough working capital to kind of manage their exchange. And they can programmatically adjust the balances between the two wallets. So it's all kind of done very seamlessly in the back. And then they can build their exchange on top of our tech stack.
What I like about this is there has been a conversation that, and maybe I've not spoken to the right people, but people were trying to get insurance products or specific insurance products over crypto assets. And to my mind, the insurance market was playing around with it, still figuring it out. There are some policies. But maybe that's not the right answer. Maybe it's not that you need to have a policy over those assets. It's what you're talking about, is having a policy over a trust or having it over another type of asset that controls it, maybe even over a private key.
I think so too, because ultimately it's about who controls the asset and how it's controlled, and is that asset on chain or off chain? How are the keys generated on or off chain, etc. So having it in a sort of legal structure that is recognized by most insurance policies, having the keys generated offline, I can imagine someone saying, "Oh, well, I have these assets, but I regularly put them on Uniswap and I just hold them in my ledger. Can you insure them?" Probably the answer is a resounding no. Because
I think probably is going to be a no. Yeah.
So, but I think obviously the insurance market, either the TradFi insurance market and the sort of organic insurance market within crypto, like this Nexus Mutual and some other sort of protocols out there, are probably getting more and more comfortable insuring some forms of digital assets, but that's
it's comfortability, it's education, it's an understanding of how you hold them, what it means, what does control mean,
who audits a smart contract,
all of these sort of technical things that I'm sure a lot of insurance guys are now getting their head around, which is great. To some extent, this brings us to our next point, which is BitGo is regulated. You sort of spoken a little bit about that. Can you tell me more about that? Because you may be regulated in one jurisdiction, but what about others? So where are you regulated? And how is that seal of approval from the regulatory authorities translated into clients?
For some clients, it's sine qua non. It's like primordial that you get this regulatory status, because it affords you the ability to have that insurance wrapper and to know that your funds are, safe and sound in a sort of bankruptcy remote entity, that we're applying real fiduciary sort of oversight on them. So, some clients would not be able to exclusively use some form of hot wallet only tech solution just because they wouldn't, their regulator wouldn't allow it, or their internal checks and balances wouldn't, and I'm thinking of some of the sort of regulated financial institutions around the world, and some of the big crypto exchanges, etc. So no, from the client perspective, it's a necessary addition to the wallet infrastructure. We can onboard clients to any of our trusts. It's really driven by them, which entity they would rather face. So obviously in Europe, especially as Europe moves towards a sort of unified.
Well, there's regulation coming in
next year. Most of our counterparties will prefer to face our German entity, right, which is regulated by BaFin, and it's fair to say probably that Germany has the most robust regulatory framework in Europe, generally, and probably for
we're figuring it out here, aren't we? We're still figuring it out.
Yeah, although I'd be interesting to hear your views on this, but I think the UK is has done a 180, and if anything, the UK, once it sniffs an opportunity, has
dog with a bone. I think.
Dog with a bone.
I think so. Yeah. But where are you regulated? So is it like you take it sort of by region? So you might have Germany, therefore that covers all of Europe, and you may have the registration in the US, and that covers that area. Is that how it works with BitGo?
No. So that's how it could work theoretically. But we're regulated in South Dakota, so regulated by the South Dakota Division of Banking, regulated by New York by the New York Division of Financial Services, NYDFS. And then, as I said, regulated in Germany by BaFin, regulated in Switzerland by FINMA. So, but nothing is stopping a French client of ours from facing our South Dakota entity.
Well, that's what I was going to ask, because if I wanted to put money in today and I said, are you regulated? Because I'll only deal with you if you're regulated. I'm in the UK. So what would my journey with you guys look like?
Right. You would essentially, once we've agreed to onboard, you'd onboard to our various entities. So you'd onboard to our hot wallet entity, which is standard across the world, and everyone can, BitGo sort of Inc. And that's more the sort of tech solution entity. And then you would onboard to one of our trust entities, depending on, again, your jurisdictional preferences, really. So from our end, we're very agnostic as to where you integrate with. Some trust entities enable you to access and we haven't talked about this yet, our BitGo Prime entity, which is, again, our sort of ring-fenced, as the name suggests, sort of trading and liquidity entity that sits atop the.
So that's a separate entity that deals with all of that?
But it only deals with BitGo Trust. And so the advantage of that is that, again, in the ethos of not really keeping your assets in a custodial environment at all time, you're able, as a BitGo customer, from the cold wallet environment, so the trust entity, to trade through BitGo Prime as a riskless principle. Essentially, we just aggregate liquidity from 12 liquidity providers and exchanges, and just offer you the best price. And you're able to trade your assets, obviously selectively on what we offer, but quite a broad variety of assets, without your funds leaving the cold custodial environment.
Right.
So, and that's also obviously a product that's highly sought after by a lot of our clients who want to keep the majority of their assets in cold storage.
Well, I was going to ask, because I haven't gone through the terms, and I guess the answer is it depends. And I'm not comparing you to some of the exchanges, but you look at some of the exchanges and it says that legal title of those assets are with the customer. Sometimes it's with that entity or that company. How does BitGo play it? Or is the answer it depends on what sort of service people are after?
We don't have legal title over the customer's assets. So that's the whole point. They're in a trust, they're segregated.
The trust means it's...
Yeah. Absolutely. They're ring fenced. So, we know exactly, which funds belong to which account or which end customer, which wallet is allocated to X exchange. There will never be anything other than X exchanges, funds in there.
Because you see sometimes, as I say, that these providers of supposed custodial services, they say in their terms that custodial entity holds legal title. And I, as a lawyer, I look at...
Yeah, I think it was Coinbase last year, right? At some point had to do a regulatory filing in the US saying that in the event of a bankruptcy, then maybe the assets in Coinbase custody would actually form part of the bankruptcy sort of.
I remember there was Celsius and 3 hours, and there's all of that sort of stuff is.
They had absolutely no.
Crazy.
Yeah.
What should holders of crypto assets also consider when considering storage? Because me as an individual, I have a little ledger, and I just sort of keep it in my drawer.
Yeah.
But say, for instance, there's a high net worth. What would they consider? Security is one thing, but what else is there to consider for people?
I think they all go hand in hand. It's sort of what type of wallet architecture do you offer? Are you regulated? Yes or no? Do you provide insurance? What sort of checks and balances do you have on your on your policies and on your process. So what sort of audits do you undergo? So for instance, we have SOC 1 Type 2, SOC 2 Type 2 audits, which are obviously very onerous, but we do those willingly, because we have, we're sort of regulated by the Department of Financial Services, and depending on the jurisdiction that we operate in, we actually have physical inspections and audits similar, I was told, in the US at least, to what a US bank branch would expect to get from their local regulator. So it's that sort of, because we have the other thing to mention is these trust entities, like for instance in South Dakota, we actually have a physical bank vault with armed guards
somewhere under a mountain,
somewhere where obviously I know nothing about. Very strict processes of who can enter it at any given time, who can co-sign a transaction.
That's got to be an expensive option, right? Because you've got to pay for all that.
Absolutely, we need. So we haven't touched upon how big we are, but we are around 350 people across all the different functions and operations. So. We're very heavy on the engineering and product side, naturally, because we're always trying to iterate and really support. And it's a very sort of technical heavy sort of background. And we have sort of the commercial front. But our trust entities require a lot of staff, and understandably so, because you have to have very rigorous processes.
No, I understand that. I remember talking to someone who works for what I would probably say is more of a traditional asset custodial, and they were talking about having armed guards under some Swiss mountain, and is that the sort of?
Yeah, I mean that's exactly how the sort of processes that we have. Although I'm not sure there's anything in the Swiss mountains so far, but
some mountain somewhere.
Some mountain somewhere, yeah.
Maybe this is a question that you can answer quite easily, but why would I, potentially as a consumer, just as an individual, why would I use your services as opposed to anyone else's, or is BitGo not really designed for consumers like me?
So we're a B2B business, initially at the inception. This is what we do, but obviously indirectly we're very consumer facing business because a lot of our clients are B2C and use our services to secure and provide the wallet infrastructure for them. So a lot of, to the extent you have an account with most, some exchanges in Europe, you'll probably be an indirect customer of BitGo. But we are more B2B, but we do obviously in some jurisdictions, again, driven by more regulatory demand. So for instance, in Germany, we offer B2B2C, where we work with the exchanges and actually get involved in the onboarding and KYC AML of the end consumer. So we do have the opportunity and the framework and the capacity to scale if we need to, but then obviously that has to be done on a bespoke basis. But before that, I think the threshold was $1 million to kind of make sense to become a customer of ours. And now we're very much actively reducing that threshold. And I think you only need to have $25,000 worth of crypto assets to open an account with us. And why should you open an account with us? Well, everything that happened last year should give you.
We're coming on to that.
Give you the motivation to try and store. I mean, self-custody is one of the core tenets of crypto. If you have a small amount of assets and or what you're doing, I think it's a great idea, and maybe it should form part of everyone's strategy. I obviously self-custody some of my assets because it's much easier to deploy. And
it's just a USB stick. I have a little ledger and it's great.
And you have a little ledger and it's fantastic.
I really rate it. Yeah, super easy.
But here, when those assets grow, if you have a larger amount, you really want to safekeep them for the long term, then it makes sense to use us. And we have, key recovery services. If ever you lose your private key, there's an option, through, using our method to actually retrieve your funds. If you lose your ledger, that's it. Well, not your ledger, I'd say, but the seed phrases, then it becomes a lot trickier.
So what are the recovery opportunities that you provide for people?
Oh, that's on the technical side. So to be honest, that's if you if obviously you've lost one, because multi-sig is 3 keys, and you need 2 keys to sign. Okay. And depending on the type of wallet that you use, either the holder has, as in the client, has 2 keys, or BitGo has all 3 keys. So obviously only in the instance where the client loses one of his keys, then we're able to, generally we hold one of the keys so we can help him retrieve it.
Yeah.
But then if he also loses 2 keys, like depending on what he chose, if he's using like a third party provider like CoinCover or those sort of guys, then we can help them recover the keys. But we also provide services where if you send funds to the wrong blockchain, all these sort of things that you wouldn't be able to do as a retail user. And that does happen. I mean, unfortunately, you fat finger on
oh, yes.
assets. I'm sure we've all been there. But if you do it with large amounts, then we're able to more often than not recover those funds for you.
Okay. I think that's worth a conversation for another day, because that's an offering from what appears to be someone like BitGo that's institutional, that has an ability to recover funds that isn't necessarily an expensive and I would say drawn out process. It's not quite drawn out, but if there's an opportunity where someone has, as you've called it, fat fingered money to somewhere, and there is an opportunity to recover them, then I think that's definitely worth exploring. And it may well be that policy gets fleshed out a little bit further down the line, and that's another sort of marketing ploy. Now, I appreciate there's been a lot of talk about FTX on these podcasts. I try and avoid talking about it because it's saturated. But I understand that BitGo has taken custody of about $740 million worth of crypto assets. So can you tell me a little bit about what happened? How did you manage to get those assets? How they're being stored?
Sure. I mean, I think obviously I can talk to what's
what you're allowed to talk about.
Well, what I'm allowed, what's also in the public domain.
Yeah,
but
let's do that.
As you said, we've the FTX been talked about ad nauseam, right? But we, very early on in the process, as soon as the sort of bankruptcy lawyers were appointed, John Ray III or whatever his name is contacted BitGo immediately and said, we need you to secure the remaining assets that we have in our control.
So you were the first port of call?
Yeah, pretty much. And
okay.
Obviously, we onboarded them and moved those assets safely so that they can form part of the bankruptcy estate, and at least the sort of creditors know that they're sitting safely and soundly, right? Well, they wait for I'm sure the multi-year process to unravel.
It's coming, I'm sure. Yeah.
So that's how it happened, and that's testament, I guess, to our reputation and the tech stack and the trust and the regulation and insurance that we have, right? So
I was going to say that's testament to the brand and the longevity of the company.
Yeah.
Are they being stored in any particular way that's different? I know we sort of talked about armed guards and cold storage and multi-sig.
It's just going to be, cold storage. Obviously, we're very segregated to the FTX bankruptcy sort of, wallet specific to different digital assets. So they won't be stored in any different way to how our cold wallet assets are usually stored, but that is the most secure sort of thought out process way. I guess
you're used to storing them in that way, so it's not special treatment. It's everything special treatment.
Exactly.
Right. Okay, I understand. I know BitGo was also involved in the Mt. Gox Bitcoin hack back in 2014. Can you tell me about how, I suppose your role in that, how it came to be?
Sure.
A little bit about the background.
We're not involved in the hack.
No.
Yeah. So
no. Yeah. Poor choice of words. You weren't involved in the hack, but after the hack, you became involved.
Exactly. Well, after, again, I mean, FTX is just an earlier, Mt. Gox is an earlier version of FTX, I guess. So it's taken nearly 10 years to essentially come to an end. And the trustee for the estate has chosen a bunch of, trusted distribution agents, of which we are one of them, and we're the only custodian globally to be essentially selected to distribute the remainders of the estate to the end creditors, or to receive their claims. So the process is we have a dedicated website for Mt. Gox trustees. They have a sort of reference number from their trustee. They can essentially onboard with us, and we have a sort of accelerated, seamless process for them to do that. And then they will be able to receive their Bitcoin from the Mt. Gox estate into either a hot or cold wallet of their choice, and then they can actually decide to keep it there. They can move their digital assets there, or they can move it out to another wallet and move on. But we're offering them, having suffered this hack 10 years ago, a very, very safe and secure way to not only receive those digital assets, but then to secure them for the long term.
So it's a considered approach, essentially.
Absolutely.
That's quite tailor-made.
It is. It's tailor-made for them, but it shows that, again, to your question earlier about facing retail, these are obviously smaller claimants across multiple jurisdictions, hundreds, if not thousands of claimants. And we have a solution to, onboard them into our ecosystem and provide them a way to secure those assets and obviously to distribute those assets to them in the first place. So, it's absolutely a solution that we can replicate for other scenarios where, if they were to materialize.
Well, I think there's probably going to be quite a lot of class actions, representative actions, whatever it may be, where there's more than one claimant. And on that basis, it sounds like you might be quite busy in the future, or at least have more instructions, because there will be funds recovered, certainly in a civil route, almost definitely in a criminal route, whereby those assets need to be stored until people can come forward and prove that they own them.
We're always going to throw our hat in the ring, I'm sure, as a company to be part of those sort of processes of distribution, because it makes sense. We can do it at scale and effortlessly and in the most secure way. So, beyond Mt Gox, beyond FTX, but just more fundamentally, hopefully it awakens some sort of realization in the people who've been impacted by these events, that they need to have a safer solution. And now that they can do it with us, with a pretty low threshold of entry, then hopefully more of them will migrate over to use our wallet infrastructure.
And I guess that's part of it, because they've gone through a hack and there's a level of mistrust all of a sudden now that, if you guys have been around for 10 years and you trusted, then those victims will have an element of understanding that there is some trust in the process and that these things can be done properly.
Yeah, exactly. I think shortly after FTX, you had an increase 300% plus in sales of ledgers and Trezor wallets and self-custody wallets, which makes sense from a retail perspective. But, they are not the only solution, and they may be not the best. They don't scale effectively. They're not as secure at a sort of more institutional level. And some of these claimants who were comfortable using exchanges or less secure sort of forms of custody, will probably migrate to our wallet infrastructure. Yeah.
I think the answer to this question I'm about to answer is, I suppose, trusts, but I'm going to ask it anyway because there may be some more things to add. So how do you protect users' funds from third parties and, in essence, from BitGo itself? Because if there's a reason why BitGo goes under, then people's funds need to be ring-fenced. But it seems as though the answer may well be trust structures. Is there anything to add on that point, or is that the right answer?
It is. It's all about trust, yeah. So there's no commingling of funds, segregation of assets, essentially. The trust provides you with bankruptcy remoteness, and it enables you to be insured. So, those three things come together to ensure that if anything were to happen to BitGo, or ultimately the counterparty holding the assets on behalf of the clients for whom we're custodying the assets, then those assets would be safe. Because one of the things you saw with FTX, obviously, after they went down, was some funds were siphoned off.
Oh, yes.
Right? And that would never have happened in our custodial environment, because you can't move assets out of our cold storage environment, so the trust environment, without many things happening, many parties being involved. So there's enough checks and balances for that. Not even if a malicious actor or malicious actors are trying to withdraw funds, it would either be spotted or blocked very early on. You said that our policies are very robust and deliberately robust to stop these sort of transactions from coming. You have velocity limits, video facial checks above certain thresholds, whitelisting of addresses you can send things to. Obviously multiple people need to approve the transaction. So just one rogue or a few rogue sort of employees of FTX who were able to move $300-400 million of assets would not have been able to do that.
That makes sense. And I guess your phrase quite rightly was checks and balances. My next question is sort of, it's difficult, right? But let's just say, for example, that one of or a few of the major exchanges, right, they start doing what you do. So say, for instance, they become regulated and they provide insured products. Let's just call it that. How does BitGo set itself apart, bearing in mind that some exchanges may have better goodwill or at least a stronger relationship, given that they're retail? So how would BitGo keep up if they started doing that?
I think they're doing it already, and we are keeping up, because many exchanges recognize that there has to be a separation of duty in terms of market structure, who's doing what. So
we're seeing that with everybody, aren't we?
We're seeing that with everybody. And obviously, if they were doing it willingly before, now they're going to be doing it more through enforceability, because regulation, I think, is coming. Mm-hmm. That's going to enforce this form of market structure. So I think our business model is going to be validated. 2 weeks ago, Gary Gensler said that RIAs or RIAs in the US, registered investment advisors, to the extent that they're holding crypto assets on behalf of their end users, have to custody those assets with a qualified custodian. So we're one of the only qualified custodians in the US, have been since 2018. So unless those exchanges manage to get qualified custodial status,
they've got to catch up.
And even then, it's all about, I guess, the other way to describe it, it's all about surface of attack, and ultimately, as an exchange, custodying assets on behalf of your retail clients, there's a far greater service of attack, because then you're trading with other exchanges, you're rehypothecating those assets, you're lending, borrowing, you're doing derivative trading, there's margin involved, and hence that sort of risk assessment doesn't become just relevant to your entity, but it has elements of the other entities that you're dealing with, and then it becomes sort of exponentially harder to measure the risk. And this, again, that sort of surface attack for that specific entity. We just do custody, and our core function is to safeguard customer assets. We enable them to do more things, but always from a safe custodial environment. So their funds are never at risk. If they then obviously move their funds to an exchange or go and LP into some, very sort of left field DeFi protocol with their funds, that's their own right. But they, as long as they remain in our custodial environment, they will not be at risk. And that's why you have some of our competitors are custodians and exchanges, and then also offered, yield products, which were not.
Well, there's a lot of that at the moment.
Right.
There's a lot of yield products.
Products were quite arcane and intransparent, and obviously have, led to quite a, in some instances, quite a lot of those assets being tied up, because some of the counterparties that we're dealing with have gone under or in bankruptcy proceedings, and then their end retail customers cannot get those funds back. So that's not our business. We are not going to.
You're focusing on one thing.
Absolutely.
So if you're, I suppose you're not waiting for third-party providers, exchanges, whatever we want to call them. You're not waiting for them to catch up, but say they do, right? And they provide similar services to you with the products that you provide. How, in the next 5-10 years, do you foresee BitGo's business changing? What does custody look like in 5-10 years?
Yeah, I mean,
I bet, bearing in mind, that's probably a really difficult question to ask, because 10 years is a long way. Let's do 2. Let's do 2 years.
We can do 2. We can do medium and long term. But I think it's the old pie analogy, right?
Yeah.
So, our slice might shrink, but the pie itself will grow probably by multiples of what it is now. Because more real world assets will come onto the blockchain. More people will be comfortable using the blockchain. I mean, especially if you fast forward 5 or 10 years time, there'll be tokenization. Web3 will be a thing. Obviously, we're still mostly web browser based, all of us, hardly any of us probably use MetaMask even on our mobile, just to check some NFTs, but it's not, we haven't had that mobile moment yet, and that's coming, and that's going to be a huge vector of adoption, and obviously we're going to be involved in that. We have we're developing our own wallet actually called Harbor Wallet, which should come out this year. So that'll be a kind of Web3 secure.
That's a plugin like MetaMask, is it?
Like it will enable you to access MetaMask and a variety of other DeFis, but it will also use our actually MPC wallet technology, which is TSS in our particular case, but it's an alternative to multi-sig, which is more suited for the sort of Web3 world. But hence, I'm not worried about BitGo's ability to stay relevant in the space and to scale, because the pie will be so much larger, and there will always be a space for a custodian. And we have that track record as well. So you have people trying to, and rightly so, it's good to have competitors, and you see
they'll keep you on your toes.
Keep us on our toes. You see real world custodians come in, the State Streets and the sort of Northern Trust of this world. But you can't just replicate a 10-year-old tech stack overnight, even with the best intentions and the best resources. It takes time to gain that trust and to scale that technology and to get the licenses and the processes and procedures in place for them to catch up. So
is it a matter then that maybe the next few years is going to be the tokenization of real world assets, and that's what's going to need custodial services? Because from people I speak to, it seems like a lot of the market is talking about tokenizing real world assets and what that looks like. You know, for instance, property or, you know, shares, bonds, equity in a racehorse, whatever it may be, right? Maybe that's the next step as people get more comfortable with blockchain tech.
I mean, the tech is already there and available for that, to be honest. I think it's just jurisdictional and regulatory driven more than anything else, because it's really ultimately, how do you prove you have a claim on the underlying assets that you're meant to be, you know, sort of tokenizing, and it gets more and more complicated when it's less and less liquid, I guess. So you need to solve for that rather than the actual blockchain, and you need to get people comfortable transacting in a dematerialized, tokenized fashion, rather than...
It's comfortability.
It's comfortability.
Yeah, 100%. And I just want to check to make sure, BitGo also looks after NFTs?
Yeah, absolutely. So you can trade and custody. So there's two angles, I guess, with the NFTs. So from the wallet architecture I described, you know, as I said, we want you to deploy your funds. So staking, trading, borrow, lend, access to DeFi, and then also NFTs. So if you're an NFT fund, of which there are several now, you know, large, and they actively buy and sell NFTs and store them, you can store NFTs in our cold wallets. You can sell and trade NFTs from a hot and cold wallets. So that's one angle. So absolutely, because they're an ERC sort of type token, when we support NFTs on other blockchains too, like Polygon, which is obviously doing many things in the retail world. So that's one angle. And then the other sort of more bespoke but / turnkey, depending on how you're looking at it, solution is we offer big brands the ability to deploy or develop and deploy at scale, but always safely, an NFT marketplace, for instance, or a Web3 a marketplace with their end users. So we worked with one of the biggest brands in the world recently, in the sports industry, to deploy their.
Can you say who it is or not at this stage?
People Google it.
People Google it. Fine.
Yeah, they'll find it. It's just some sensitivities.
Yeah. Fair enough.
Mentioning the name, but we helped them launch their Web3 sort of marketplace, which is, in my mind, going to be one of the major Trojan horses of the broader adoption for this sort of because they're so big and it's already got such attention. Yeah, and we're working with many similar brands to do that. So absolutely, we support NFTs. It's something that we're focusing a lot of resources and interest on. And it's as the blockchain world becomes more mobile, it's going to become even more relevant. As I told you before we started this podcast, I was recently at NFT Paris, and there was 10,000 people there. I mean, fantastic interest from various global brands about what this can unlock in terms of customer engagement and the future of their business models.
Well, especially fashion brands, that's huge at the moment.
Fashion, e-commerce, but automobile companies. I think it's really how you want to develop that community, really, and then work with that community to drive your brand forward in terms of how. And these are increasingly digital native end users, so you really have to kind of go and speak to them, and they're expected, because of their interaction with crypto, to have a say in how things are architected and developed.
Does BitGo then act as a consultancy for Web3 as well as all this custodial stuff we're talking about? It seems as though there's an element of consultancy to get into that space. How do big brands do that? Is that true, or is that not quite right?
I wouldn't frame it as a consultancy, but because
what's the best way to frame it?
It's as a we're certainly someone with a strong opinion as to how things should be done, and we have a tried and tested method, and we have the skills to be very adaptive. So we can model any type of strategy according to, does it need to be custodial, non-custodial? What type of jurisdiction it's going to be in? Is it going to be closed loop, as in only crypto will be traded initially, or will it be open loop, as in can you bring in fiat money? Can you bring it to other types of platforms? So we can really architect it in any way these brands want to do. So I think indirectly we're a consultant, because we understand the space very well, and we understand what needs to be done properly initially for it to be scalable, for millions and millions of users. But there's a lot of brand consultants and consumer consultants and strategic consultants. And
I'm wondering whether you can sort of wipe them out of the way, because you guys
I think
know what you're doing.
We're all working towards the same end goal. So we all work together. Yeah.
Well, I think on that note, I'd like to thank you for coming down and doing this. Really appreciate your time.
That was fantastic, Matt. Really good to be here.
Thanks very much.
Thank you.
This podcast does not contain any financial or legal advice, and you should not seek to rely on it as such. Opinions are the individual's own. This podcast was produced and edited by Joe Hawkins and music by Luke Carey. Thank you for listening, and see you next time.